Speaking again. Good morning, everybody. Hopefully you can hear and see myself, Matt Hall from Armadillo. I'm very pleased to be joined this morning by Matt and Stephen from Henry Dannell, our sort of mortgage and finance brokerage specialists that we work with. We've referred a handful of clients to the guys at Henry Dannell over the last sort of 6 to 12 months. I guess our initial focus on the relationship was still as topical as ever, and Matt or Stephen will touch on it a little bit, in that there's always a tax angle when I'm involved, and that remains the case. I think the thing that strikes me or struck me in the budget, which hasn't had a great deal of attention, is the additional 1.5% that is going to be added to interest on late paid income tax. And obviously, we've got a number of individuals and firms have got many clients who are facing tax liabilities. And when those interest rates will hit 8.75% from April, and indeed with the HMRC add a further 1% on top of that for the privilege of paying in instalments, it becomes rapidly clear that there might well be cheaper sources of finances in the market than paying something like 9.75% on interest, even if it's the slightly dubious chap down the road who'll pay you a visit with a baseball bat if you don't pay. Such are HMRC's ridiculous rates. So we've worked with Henry Dannell, as I say, over a period of time, looking at, say, mortgages, self-interest, and also trying to help clients find financial structuring and ways to manage tax liabilities, whether that be, say, unexpected liabilities for income tax, for example, or, as we'll touch on this morning, inheritance tax. And certainly some of the changes announced in the budget have attracted a great deal of attention, and farmers dominating the news. But obviously the changes to business property relief as well as APR will have a much bigger effect, perhaps, on more of our clients. So I'm delighted to hand over to Stephen and Matt from Henry Dannell. If anybody has any questions, feel free to pop them in the chat. I will keep an eye on that. If you prefer to answer a question in person, feel free to just click on the raise hand button at the bottom of your screen, which you will see if you hover your mouse over the screen at the bottom. And I will open up questions to you at the right time. So without further ado, over to the team from Henry Dannell.
Wonderful stuff. Matt, thank you so much indeed for the introduction, and good morning to you all. It's wonderful to be speaking. So as Matt has very kindly said, my name is Stephen. I'm the Senior Mortgage and Protection Advisor at Henry Dannell Private Clients Limited, and I'm joined by my learned colleague, Matt Carrigal, who is our specialist finance expert in the world of commercial, bridging and beyond. So what we'd like to do today is give you just a brief mortgage market update, cover some of the matters there that Matt has very kindly touched on, and we do of course welcome any interaction or questions from you all as we go. So without further ado, we shall press on. And what we're going to be discussing today. So we're looking at the current credit landscape in terms of where rates are at the moment, and future expectations of where we're hoping and expecting them to be over the short and medium term future. We're also looking at opportunities and strategies of navigating the post-budget landscape. And obviously, if you would like to partner with us, we'd love to work with you and take any inquiries that you may have. And we will, of course, give you some information and detail as to how you'll be able to do that. So the current market and expectations. So a bit of an overview of where we are now and where we found ourselves over the last number of months. So pleased to say that finally we are in a position of reducing inflation. So we all know how things took a rather nasty turn at the end of 2021 and the start of 2022, when we sort of had that perfect storm of the demand for goods and services as we came out of COVID lockdowns, combined with the war in Ukraine, leading to very sharp upticks in inflation throughout 2022, and then the Bank of England setting out on their rate rising cycle thereafter, which continued, as we know, for many months thereafter. But pleased to say that inflation seems to be back in a better place now, with prices coming back to normal. And the Bank of England have now started their cutting cycle, which we're pleased to see. See that there's commentary now that this is potentially not expected to be cut again this side of Christmas or the new year, but wide-ranging forecasts and commentary does expect that this should be hopefully around the region of 3.75 to 4% for the base rate by the end of 2025. So what that's done is, anecdotally for us over the last 18 months to 2 years has really brought the debate of tracker rate mortgages versus fixed rate mortgages into very sharp focus. So where we've seen a lot of clients opting for tracker rates is to just take advantage of the flexibility that comes with such a mortgage product. So traditionally, tracker rate mortgages will have no exit penalties and an unlimited overpayment allowance. And what this has provided is flexibility for clients to adopt a bit more of a wait and see approach rather than potentially locking into a fixed rate when we're in a bit of an uncertain environment and we've had some maybe higher interest rates than we have been used to over the last maybe 4 to 5 years. So, the importance of independent advice in that regard has been more acute than ever. So we did take a lot of clients who were sort of hedging their bets, taking the tracker rate mortgage just to see where fixed rates would start to land. And as we've seen now with 2 cuts to the Bank of England base rate at the last 2 meetings of the MPC, that does appear to have paid off for some. Some will have a line in the sand when they'll decide to come out sideways and fix when rates hit a certain level. That, of course, is going to be different for everybody based on their personal circumstances. But it's been a much more sharp tool in the armory recently, where we've had a lot of clients taking that flexible approach while they wait for fixed rates to get back to their line in the sand. So the reduced base rate, which we've touched on, again, we forecast this hopefully to keep reducing over the course of 2025 and hopefully landing around the 4% mark by the end of next year. So the forecast on rates, well, our house view is for cautious optimism. We are still anticipating downward pressure on fixed rate mortgage pricing in the new year. Since the budget on the 30th of October, and dare I say, not the last time that we'll mention the budget in today's presentation, but we did see a small spike in swap rates, which essentially is how fixed rate mortgages are priced on the market. So swap rates have been increasing over the last number of weeks, which has led to some upward pressure on retail fixed rate pricing. The cynic in me suggests as well that there might be a two-pronged approach here from lenders, increasing rates towards the end of 2024 when potentially they've already hit their lending targets for the year. It allows them to come out and seem very generous if they do cut rates, perhaps in January or February of 2025, which we wouldn't be surprised to see as they try to make a good start on their lending targets for next year. So there's potentially also an element of salesmanship involved in those raising of rates that we've seen of late. But to summarise, we've got cautious optimism ahead for the next 6 to 12 months as far as rates are concerned. And certainly we would expect to see some more downward pressure on fixed rate pricing as we see some more settling from the fallout of both the budget and the election overseas in the US as well.
Stephen, do you expect the uptick in inflation recently to be short-lived? Is that what the market's expecting?
Yes, I think so. I think checking swap rates this morning, we've certainly had no sort of major panic or adverse reaction to the most recent set of data. I think it's pretty well baked into mortgage pricing at the moment. I don't think we're not as susceptible to the short, sharp shocks that we were getting a lot as we saw the sort of, dare I say, in the post Liz Truss period, which hopefully that's a long way in the rearview mirror now. But no, I don't think we're foreseeing any sort of long term fallout or negative impact on rates as a result of the recent spike. It may be that it doesn't sort of settle as to where we would like it as we come into the winter period now, with again some upward pressure on energy prices potentially. But no, not something that we are seeing having an adverse long term effect. I know the Bank of England have come out and given some commentary that it may cause them to just pump the brakes a little bit, and we're not going to get another cut this year. Again, I think that would have been the case regardless of the latest spike in inflation data. To be honest, I think it gives them a bit of time to settle, reassess, and then continue with the cutting cycle next year. I mean, what I would say is perhaps there won't be, I think we had 5 or 6 cuts forecast. I think maybe that's down now closer to 4 or 5 next year. But yeah, anywhere from 3.75 to 4%, I think would be a sensible estimate, hopefully for this time next year for the base rates.
Thank you.
So, speaking of the post-budget landscape, and appreciate that we're just about 3 or 4 weeks after it, and of course, no doubt you will all have seen lots of commentary and coverage in the media around the fallout of the budget. So we've decided to try and be positive and focus on some of the opportunities and strategies that the one may look to make use of now that we've got an idea of what has actually come out of the much anticipated budget of last month. So strategies to reduce IHT liability. So I guess I would qualify and caveat this slide in the first instance that our role is as mortgage and protection advisors. So we're not tax advisors per se. We don't give specific tax advice. But what we can do is where a liability perhaps has been established by yourself or by the client's wealth manager, whoever it may be, that's when we can then assist with looking to mitigate or offset that liability with a number of solutions. And a couple that I'll touch on this slide. So utilizing debt again. So we have seen some changes to the inheritance tax rules in the most recent budget, and as Matt touched on at the start of the call, clearly any of us with farmers or agricultural clients are going to particularly be feeling this quite acutely. So we anticipate that gifting as a strategy, for example, may well increase and may well continue into 2025, as it seems if one doesn't spend it or give it away in time, then you're going to pay at least one round of tax on it. So yes, best to get on with it. So how can we offset that or mitigate that risk? So debt for a long time has been a very positive example of how this could potentially be offset. And touching here on the later life mortgages. So equity release, as they're also known, although that has had a slightly negative connotation in the past, I think somewhat unfairly, but it is what it is. So later life mortgages, we are increasingly now being seen to be used as a vehicle to mitigate inheritance tax liability, whereby the later life mortgage is placed on potentially a mortgage-free main residence. And essentially, as the interest accrues and debt builds up, which is what happens with a later life mortgage, the interest doesn't need to be serviced. And essentially, on death or calculation of the estate for inheritance tax purposes, that mortgage is deducted from the value of the estate. So it's actually reducing the value of the estate by the balance of that outstanding lifetime mortgage. A reasonably aggressive tax planning scenario there is we are securing debt on the main residence, and it does roll up over time if the interest isn't serviced. So it can lead to a reduction in the estate that is potentially passed on to beneficiaries or children, but absolutely an option for the right client, depending on what the inheritance tax liability is looking like. Concessionary purchases. So this is an arrangement whereby a parent or family member can sell their property at a concessionary price to another family member or to children. So they can thereby gift the equity in the property. So it may be that the children can't raise a full deposit to purchase the property from their parents. So that equity can essentially be gifted to the children, who can raise a mortgage for the difference. So I'll use a real world example which may help to better illustrate this point. You may have a property valued at £500,000 and the children are able to raise a mortgage of 350,000 based on their income, their expenditure, and the bank can afford to lend them 350,000. They may not have that £150,000 deposit available. They may not have all of it. They may only have some of it. And then the seller, so the parents, if they're selling the property to dependent children, can potentially gift some or all of that equity, which would then be used as the deposit, essentially. So cash doesn't have to physically change hands as part of the transaction. The equity in the property is gifted to the children and makes up the deposit, and the children take out the £350,000 mortgage. So that's a concessionary purchase, which is widely available on the high street and something that's become very popular among children wishing to purchase properties from their parents. Now, again, without straying into tax advice on some of the implications of children purchasing property from parents, obviously they would need to then be treating it as their own main residence if they purchased the property. They couldn't do this and let mum and dad keep living there or paying them anything less than a market rent. So a word of caution on that one. If anybody tries to be perhaps too creative, if we've got some clients who maybe have seen one of their friends or colleagues have made use of that, yes, maybe just a word of warning there that it does need to still be, of course, in line with HMRC's expectations of whose main residence it's going to be on completion. And life assurance policies. So I'm taking responsibility for protection at Henry Dannell, and what we have seen recently is a real uptick in the inquiries around life assurance policies to mitigate an inheritance tax debt, or an inheritance tax liability, I should say. Um, Plenty of inquiries on this, and we've got lots of options to assist. We've got a case study coming up on one of the slides shortly, which I think will be the best way for me to perhaps explain this in a real world example. So we were approached by an introducer whose client had given £18.5 million away to his late wife's children. Nice to be in a position to do that, I know, but he had been advised this was the best way to sort of manage and plan his estate. So £18.5 million had been gifted to the three children. 76-year-old retired physician, very lovely chap, very fit and well, and he had taken instruction from his lawyer, private client lawyer, who was the introducer to us, that the inheritance tax liability was in the region of £7.5 million. So this liability then for the next 7 years after the gifts have been made needs to be accounted for, because God forbid if the chap was to pass away, the children, the beneficiaries on the hook are on the hook in the first 3 years for up to £7.5 million in inheritance tax. So what we've done is we have arranged a series of life assurance policies which will pay out the relevant amount equivalent to whatever the liability is at the time. So you would, of course, have the option of putting a £7.5 million policy in place for 7 years based on current planning as the tapered relief stands today. But that's not potentially the most cost-effective scenario. It's sort of an easy go-to option. And if you're speaking to advisors who maybe aren't experts in this type of insurance, maybe not providing the best value for money or the best advice for the client. So what we've done is we've structured it in such a way that at no point during the next 7 years is the client overinsured and the beneficiaries aren't overpaying for the cover. So the policies can be placed into trust. So they're not going to pay out into the donor's estate. So he's not going to be hit with a double whammy, because of course that would be a real nightmare if if the insurance that we're arranging to mitigate the tax gets paid into the estate, then essentially we're increasing the risk. So these can be placed into trust so that the payouts are paid to the beneficiaries at the right time, giving them the ability to pay that inheritance tax liability should the chap pass away within the next 7 years. So again, what we won't do is we won't calculate the liability ourselves. We will leave that to the experts. And once we have been told what that liability is, then that's when we can have discussions with you about what's going to be best for the client, be that a number of term assurance policies or even potentially whole of life policies as well. Again, depending on what the recommendation is and what the liability is going to be, we're always happy to have proactive and inclusive discussions with you and your clients from the outset. And perhaps I should have pointed out earlier, but to clarify as well, we're absolutely not interested in taking your clients away from you. Far from it. We want to work with you. And if you're establishing that need, you're establishing what that liability is, then we want you involved throughout the process as well, so that we can explain what we're doing to you, what our advice is, and how we're going to put those plans in motion. So I am just going to pause for a moment. Seen a couple of questions come through just before we pass on to Matt, my colleague, who's going to maybe switch tack just a little bit. So Gordon has asked a question: concession repurchase may also trigger CGT payable within 60 days given property sold, not at arm's length. And Matt, I think you've come in and you've given some commentary on this one.
Yeah, I think the scenario I've seen people look at this is where the parents it's their principal private residence, it's the family home. So they would get PPR relief. The scenario I saw it, the parents effectively wanted to keep the family home in the family, sold it to the kids. Kids couldn't, exactly as the example you used, kids couldn't afford the equity in it, if you like, but could raise enough to buy the parents out sufficiently to allow them to downsize into something more modest, and the kids kept the family home, and the parents claimed PPR relief on the market value of the transaction. So I've not seen it used. I don't know whether you have, Stephen, in the context of, say, investment properties where there would be a potential CGT liability that would have to be factored in, I guess.
Yeah, I mean, it's not something that I have seen too much in the buy-to-let side of things. To be honest with you, it generally is in relation to the PPR that we notice the concession repurchases. It's not to say that it couldn't be done, but it's just we see much more of our examples are in the passing of the PPR to the children, as you quite rightly pointed out. But yes, so yeah, Gordon, as you've said, it's something that we are very keen to stress. We do have some lenders will allow, for example, the family to remain resident in the property on completion, as long as the children are also residents. So that's a very important point to make. So it's not to say that so an example that we had very recently, children were purchasing from parents. So it was going to be the children's home on completion, but they weren't making their parents move out. There are some lenders that will allow that. Not all will, but clearly we would need to know that. But what they can't do is have the children buy it, get a main residential mortgage, and then continue to live elsewhere or to rent. So it's they're not going to have to be casting the parents out. It's not quite that harsh. They may want to, but no, there are some lenders that will allow all parties to then reside in the same primary residence on completion.
If they do, of course, as you again touched on earlier, and the gift of the equity element, they would have to be aware of the gift with reservation of benefits, as rules I still refer to them as. So there are complications to that. As I say, I think it's a scenario that works quite nicely where there's often a familial sort of affinity to a house, the family home. It's been in the family for a number of years, for example, and they want the kids to be able to move into it as well, or and then downsize. But as I said, they can't quite afford the full whack. There's an opportunity to sort of keep it within the family without it triggering a tax liability.
Of course.
There's a question as well, which I think actually you sort of lined you up quite nicely on the later life mortgages. And I hope the questioner, who I won't name, in case everyone can't see it, I hope the questioner won't be offended by that. But I'm guessing somebody who's over the age of 60 would constitute someone who qualifies for later life. I'm not entirely sure. I'll let you answer that. The question is mortgage-free property, looking to add an extension, could fund the cost, but would prefer to borrow and have an interest-free loan to be repaid later on, perhaps, for example, in this case where pensions kick in. Is this possible?
Interest-free loan would be lovely. Sadly, we're not that good that we can arrange interest-free borrowing. If you're referring perhaps to interest only, and yes, I can see the question from the attendee, and thanks very much indeed for getting in touch. We could potentially look at an interest-only mortgage for you. Yes, that is quite possibly an option. That will depend on your income, outgoings, and some other pieces of criteria. What perhaps I'll do is I'll answer the question broadly for everyone in attendance, and then perhaps you and I can pick up this offline after the webinar, and we can look at your personal circumstances in a bit more detail. So part of our strength as well, how will I word this nicely and in a sort of politically correct way? If one is to approach a later life mortgage advisor, and later life mortgages are all they do, then that is all they will recommend you. Now, that may be whether or not they're right for you or not. We can assist with later life mortgages, but we also assist with traditional residential regulated mortgages. And we will always see what we can do in the normal residential space before we go to later life lending for a couple of reasons. Plenty of lenders now are looking at lending beyond the state pension age. Some will routinely go to age 70, some will go to age 75, some will even go to age 80. These can all be options that are much more cost effective than running straight for a later life mortgage or a lifetime mortgage, just because one happens to be eligible. For a number of reasons, of course, the interest rates on later life mortgages are going to be higher than a standard residential mortgage. And it might be that a later life mortgage is appropriate further down the line, but just not right now. So it could be that we get maybe one or even two more regular residential mortgages for a client. And the exit longer term may be for a later life mortgage at that point. But certainly in the example that the person has given in the chat function here, a later life mortgage wouldn't be my first avenue. I prefer to explore a traditional mortgage in the first instance, because age 61. Still plenty young enough for options out in the market. So we could potentially be looking at terms, as you've mentioned here, to age 68. That's absolutely fine. Not a problem at all. This is something that we'd be delighted to help you with. So perhaps if the person asking would like to wait behind at the end of the webinar, we can arrange a time to speak and get in touch to discuss your inquiry in a bit more of a private manner, if that would suit. But yes, an important point to note where later life mortgages are an option, but they may not always be the right option. So something else that we can assist with is if someone has an undrawn pension pot, for example, as long as they're eligible to access it, so generally age 55 and over, we can sometimes assign a notional income to that pension pot or to a general investment account. Example is someone has £1 million in an investment account, they're not taking it. but it is there. As long as generally the assets are in sterling, we've got lenders who will assign a 4 or 5% income, a notional income to that. So it could be a £50,000 salary, which they're not drawing. They're not getting paid essentially, but that's an option that we can use towards affordability for a mortgage. But they're not having to liquidate that portfolio. They're not having to draw from those assets or draw from the pension, but the lender can just see that it is there and they can use that to get comfortable. Again, that's an option that some advisors can't or won't explore. They may run straight to the later life mortgage or encourage people to liquidate assets. We will always look at, on a holistic basis. We've got plenty of tools in the armory to look at the most cost-effective option, because especially when it comes to later life, it can be the difference in saving tens or hundreds of thousands of pounds on the estate in interest over, just a few years. Wonderful. Thanks very much indeed to all for the questions and the engagement so far. Perhaps now a good opportunity for me to pass over to my colleague, Mr. Carrigal, who's going to give us a bit of an overview on the specialist lending side of our offering at Henry Dannell.
Good morning, all, and thank you, Stephen and Matt, for the kind introduction. So my name's Matt, and I'm part of the specialist team here at Henry Dannell. And we've got 4 points here that we'd like to discuss with you today. And I get involved in all things that's typically not your main residence unless there's a speciality or a special need where we need to utilize the main res as security. But I'll start with, one of the easier wins is a review of one of your clients' residential real estate portfolio. There's some easy wins there in terms of, we'll typically see legacy relationships where the client would have been with, with their high street lender or a private bank for 5, 10, or 15 years almost. We've seen recently where we'll be able to review the portfolio, ensure that it's the best product, we're leveraging where we need to, or, one way we can assist is converting it from a repayment model to an interest-only model. That's been quite popular over the past 24 months. Space or trading businesses. Welcome back, Stephen. Trading businesses that allows them to purchase the premises that they operate out of. And there's also, purchasing commercial real estate, which has planning permission for conversion to residential. First-time developers or experienced developers, we can certainly add value there. While Stephen brings up the template that we was working off, I'll carry on. The third point was structures. So we are seeing buy-to-let landlords, for example, look to purchase rather than purchasing in personal name. We are seeing family investment companies, UK SPVs, SIPs, all sorts of structures that are being, the client is being advised to utilize as a vehicle to purchase real estate. We are able to assist in all of those forms, whether that's for flexibility, efficiency, or inheritance planning. Most recently, FICs have been quite popular, adding children on via B shares or C shares. A lot more lenders are becoming accustomed to supporting in these scenarios, whereas historically this was, trusts and structures were more difficult. And as Matt mentioned earlier in the conversation, raising debt for tax liabilities. I'd say this was always there. We always, I always had demand for raising debt on real estate, whether that's the main residence or portfolio, assets within the portfolio has always been there. But within, over the past 24 months, where we've seen a massive influx in that demand, we can arrange debt in all shapes. We can structure it sitting behind the first charge, behind your high street lender, typically like Barclays or Santander. All of those lenders are accustomed to having second line of funding, and what that does is once you blend the rates, instead of taking out the first charge, we're able to have better blended rate, and you're able to secure the better first charge high street product that you have. Especially with the increase the increased interest on late payments, where we expect that demand to only increase and grow. And lenders historically, again, they were quite nervous lending for tax liabilities. Now it's become, not, I wouldn't say the market norm, but a lot more lenders are accustomed and understand why the demand is there and why a client would do that. I think those are my 4 points that I wanted to talk through. I don't know if we have any questions, or Matt, if you have any questions.
There's a question that one of the attendees has asked, which I'll come to in a second. I just want to touch on the point 4, the raising debt for tax liabilities. All of our members, or the vast majority of them, will have clients who have got either crystallized or very likely tax debts. And personally, my view is that there isn't enough focus that's been given to rather colourfully described it at the beginning, but the charging of late payment interest at 8.75% from April, and then adding another 1% for people who could least afford it. So you're effectively charging 9.75% interest for payment plans is, I don't think it's befitting of government, frankly, but there we are. It's a scandalous interest rate. And for people who are asset rich but cash poor, who have equity in properties, etc., I would always encourage anyone to try and explore the borrowing market with experts at Henry Dannell before committing to a payment plan that HMRC are charging you 9.75% on, because I suspect, Matt, you can probably do a bit better than that. So yeah, that's just something I feel, I suppose, given the day job, feel quite strongly about that's something that people really should explore perhaps more than they do. Question is probably more of a tax question, which is, are fixed conventional planning or higher risk? I think from a tax point of view, it depends who you ask and what you do with it. Have you got a view on it, Matt, from a lending point of view?
From a lending point of view, it's very similar to a limited company in how it's looked at. It's just with, some B shares for children, and they're on the company. There are ways that we could restructure that where, shareholding is at a level, if we capture 75% shareholding with one director only, any background structure does not need to be included on the application. So it may seem, that we're doing something complex. It's just actually we're satisfying the lender's requirements as to how they want to see a deal, and we're able to utilize, some of the more competitive specialist buy-to-let lenders in these scenarios.
From a tax point of view, Julian, I don't think they need to be viewed as higher risk necessarily. Wealthy families have used investment companies to manage their wealth, perhaps since time began. They're perhaps becoming more common in the more mass affluent market rather than the sort of uber wealthy that have historically always used trusts or corporates to manage family investments and wealth. And as I say, I think as with anything, it depends on what you're doing within them. But they're not new, that's for sure. So yeah, again, I think, will it be something that HMRC want to look at in more detail in the future? Quite possibly, because often their compliance focus is driven by taxpayer behaviour. So if they see a significant uptick in their use and what they're being used to do, then, an increase in HMRC compliance activity is probably would follow. There's one more question. I'm not sure if this will be for Stephen or you, Matt, but the questioner asks, I've always been hesitant about expensive arranged life assurance policy. Sorry. I've always been hesitant about, I think, how expensive an arranged life assurance policy would be. Presumed based on age and health, do premiums paid by the donor qualify as a gift out of income?
Yes, I'll field that one. And thank you, Gordon, for your question. Apologies as well if we did lose the presentation for a short moment there. I'm a slave to the powers of technology and was let down there for a moment. So apologies if you lost us. But yes, Gordon, thanks very much for getting in touch. So they are priced based on age and health. Yes, correct. So if you were looking for an indicative premium or an indicative quote for premiums for us, for your clients, all I would essentially need is the date of birth, smoker status, height and weight would be useful. And of course, how much it is that you're looking for. In terms of whether or not they are expensive, the older someone is or the higher the premium, then, the more expensive the policies are going to be. But again, this is where, our sort of wider approach as to how we look at something is potentially going to provide a bit more value for money. So someone may initially approach you or us for a whole of life policy. Now, a whole of life policy, of course, is guaranteed to pay the premiums at some point. So they are expensive on the sort of scale of how insurance looks. But term assurance, if it's just to an age or for a certain amount of years, potentially may still be just as good in terms of planning to for example, mitigate the risk of a gift and that liability, at a much more cost-effective option for the client. So yes, premiums will be based on age and health in the first instance. We are whole of market and independent when it comes to our insurance broking, so we're not tied to a panel. Some advisors can only give recommendations for insurers or from a number of insurers, whereas we can speak to everybody. Although the market has been somewhat consolidated over the last couple of years, but perhaps that's a topic for another webinar. But in terms of premiums being paid by the donor qualifying as gifts out of income, I would have to say that is not something that I don't know is a short answer, and I apologize for that. That strays slightly outside of my remit and the extent of my knowledge. However, what I would say, we do see quite often, is a couple of options. First of all, the policies can be arranged on a life of another basis, whereby my wife may choose to insure me, and she owns the policy. The policy will pay out when I die. She therefore is responsible for payments of the premiums, and she will receive that sum assured. So if it is the donor who needs to be insured, quite often and quite popular, the donor says, well, first of all, I've already given you the gift and the liability is on me and the payout is for your benefit. So really, you may want to pay for this. That's not a problem. So the policies can be set up where they're owned, for example, by the children. The children pay the premiums, and it's potentially the parents or the grandparent who's insured. When they die, the policy proceeds are then paid to the children, either directly or into a trust. So that is one way that it can be structured. But I would have to be honest with you there, Gordon. I actually don't know the answer in terms of if the premiums being paid by the donor qualifies as gifts out of income. That may, Matt, I'll be corrected by you, might stray slightly more into tax advice potentially, or something that a wealth planner might be able to assist with specifically. So apologies, yeah. I can't give a clearer steer on that, Gordon.
Yeah, I think it is a tax question. Yeah. And I think, Gordon, what you've probably got in mind are the exemptions for gifts out of income, which don't affect your lifestyle. And I think, I would expect, unless the premiums are very high, that exemption would be available from an IHT point of view, for example. I think, Stephen, my guess is the scenario where term assurance is most commonly used is to cover the reducing IHT liability after a gift, after a pet.
Correct.
That's, for example, a gift of shares. Then the income on the shares gifted, dividends, for example, might be used to pay the premiums for the benefit, which then gets paid to the children, who can pay the IHT if the person who made the gift doesn't survive the 7 years. I guess that's the common scenario, is it?
Yes, indeed it is. Yeah, or it may be that, for example, in the scenario that we touched on earlier in our case study, where the children had been gifted I think it was 18.5 million, they're setting aside from that gift the price of the premiums. So, they either pay £120,000, I think it is, for the first 3 years to cover the cost of those premiums. I know this is potentially the upper end of the scale of the cases that we look at. Not everyone is potentially having to budget that much for insurance, but I think compared to the alternative of 7.5 million to HMRC, certainly I think it's a no-brainer really as far as that's concerned. But yes, arranging policies on a life of another basis or in trust, we're always happy to help on that regard. I would also say a couple of things on the insurance side of things. We typically do not charge our clients fees for arranging these types of insurance products, particularly if your client is maybe getting slightly older or may have some health issues. There's no harm in approaching us and getting an application done, getting it underwritten, because the underwriting may involve medical underwriting, for example, the need for a medical, blood test, urine test, writing to a GP, for example, which can sometimes take anywhere from 6 to 10 weeks. Financial underwriting generally is not too tricky, as long as we've got commentary from a suitably qualified party, so yourselves, to confirm that the liability is $1 million or $2 million or whatever it is that we're insuring. That generally takes care of the financial side of things. But we encourage early engagement if that is an option, or it is a route you wish to go down as part of your financial planning and part of your tax advice, because if it's something that we can't assist with, we'd of course rather let you know sooner rather than later. And when I say that we can't assist with, it may be that due to health reasons, your client cannot achieve cover, or the cover is actually going to cost potentially 50 or 100% more than we thought based on their health disclosures. So I think getting an application submitted doesn't cost the clients anything. They're not on the hook to go ahead. They're not obliged to proceed, but getting the underwriting done and having the acceptance terms ready is essentially then being able to present to the client and say, okay, look, the life assurance is an option. The underwriting's been completed. It's going to cost you this much per month. This is an option. We are still exploring alternatives. But we're always happy to have conversations as early on in the process as you see fit, just to give indicative quotes, and it's never under any obligation. And we can look at alternative structures, different terms, different levels of cover, as you and your client desire. But thank you very much indeed for the question, and hope that was useful. If there's anything else anyone would like to pick up publicly or privately afterwards, then please, by all means, do let me know. So hopefully now we don't get let down for the last remaining few slides of the presentation. So working with us, how do you get in touch? And if you like the thought of what you've heard today, and if you think we could be a good fit for you in terms of recommending our services to your clients, of course, we would love to hear from you. In terms of how you can do this, as I said, we are not interested in taking your client from you. We are interested in working with you and providing solutions for your clients with you. You know, we are experts at what we do, and we stick to what we're good at. So as I've mentioned a couple of times, we're not tax advisors. We're not financial planners. We are specialist mortgage and protection and commercial credit advisors. So we will stick to what we know, and we will lean on your expertise and ask for your input throughout the process. So we are available daily, 8 a.m. to 8 p.m. You do have access to a QR code on screen as well, if this would be useful for you to make use of. Of course, I'll share some contact details for you as well at the end of the webinar. Onshore, offshore solutions for credit, not a problem at all. We're always happy to have a conversation with you. Similar to what we're arranging today, we do regular webinars, seminars, and updates on the market. We can also tailor our advice and our content depending on the types of clients that you may be servicing on a regular basis. For example, if you feel that a webinar on later life lending or whole of life insurance, or from Matt's side of things, from commercial finance, buy-to-let portfolio restructuring, commercial debt, bridging to pay tax liabilities, we can tailor that content as and when you need it. We're more than happy to come and see you guys in person, phone calls, Teams calls, whatever works for you. We have an introducer landing page at Henry Dannell, whereby you feed your details into this website, which is dedicated to our introducers and our professional partners. You submit the details of your inquiry, and we will ensure that the most appropriate member of the team is picking that up and giving you that service. If it's protection, for example, it would be myself getting in touch. If it's a commercial inquiry, it would be my colleague Matt. And if it's a residential mortgage, it could be any one of the team, but you will get that. You'll get that service from us. We're very grateful for any referrals that we receive, and we understand the trust that it takes you to put your clients in our hands. We don't take it for granted, and we understand that you are passing your clients over to us. You expect that level of service that you are giving to your client. That is what we strive to achieve. So we work with you at every step of the way, keeping you updated regularly, and also, as I've said, leaning on your expertise and your planning and the conversations that you're having with your client to complement your service and your advice. So we come towards the end of the presentation and the webinar this morning, and thanks so much. It's been great for you, for us to have your engagements and your questions. So thanks very much indeed for getting in touch. If there's anything that you'd like to pick up with us privately offline afterwards, please do drop us a message in the chat or the Q&A function now. We're happy to do that. Perhaps just while I wait for any questions to come through from you, if any of you would like to ask any questions, I'll just leave this slide up for a couple of moments so that you can see our contact details at the bottom of the screen there. You've got access to our website, our dedicated email inbox, and also our phone number as well. So please feel free to submit inquiries to us via the website or via email, and we will also be sending out a follow-up that's got details of how to access the introducer landing page that I mentioned, if that is something that you'd like to make use of to get in touch with us as well. And if you're ever in town, we're based in central London, just down the road from London Bridge at the south end of Borough High Street. If any of you know the area, we'd love to see you. So please do feel free to get in touch. So just give a couple of moments to see if there's any additional questions that come in.
I think, Stephen, whilst we just double check if there's anything else comes in, nothing at the moment. I'd like to thank you both for your time this morning. To our members, no great surprise, a webinar in which I've been involved has run a little longer than we expected, but the engagement and the questions have been very welcome. So thank you for those that have attended live. As ever, we will share a recording of the webinar with members after the event. And I think from my side, from the point of view of Armadillo, and for our accountant members in particular, I'd encourage you to think carefully about the inheritance tax changes that were announced in the budget. Clearly, the press coverage is focused very heavily on farming and agriculture and the changes to APR, but there have been changes to business property relief as well. So there is an opportunity there for you to speak to clients, to begin a conversation, if you haven't already, about what their future plans are, to look at their assets and to have a conversation about how they are going to perhaps best manage the changes and what that will mean for them in monetary terms. As accountants, tax advisors, we like to be able to put a number on something, and valuing someone's estate, and putting a cold hard number on the effect of the inheritance tax changes is often perhaps a good selling opportunity for accountants, an opportunity to engage with their clients and add additional services. And clearly, that doesn't necessarily mean you need to get involved in complex trust structures and so on and so forth. And insurance is often can be a much simpler option. It's one, I think, as accountants, because it's a regulated business that we're and tax advisors we've often steered away from. But as I say, it can often be an answer to those questions. And it should certainly, I think, for our clients, be one of the things that are considered as far as managing the changes out of the budget. So as I say, Stephen and Matt from Henry Dannell, thank you very much for this morning.
Our pleasure. Thank you.
No further questions that I
think we've got just one that's come in from Julian. Yeah. Is there a minimum lending level? Short answer is no. There's not. We're never so proud or to say that there is a minimum lending level. Absolutely not. On the commercial bridging side of things, there may be that a minimum loan amount that is required to make the transaction or the deal viable. But please don't ever think that there's a deal too small to get in touch with us. We always welcome an inquiry, and we would never turn an inquiry down based on the loan size. So to answer your question, no, there is no minimum lending level. We'll be happy to help.
Thank you. Sorry,
wonderful.
I was on the answered part of the Q&A.
No problem.
Much used to the open part, was it?
No problem at all. Yeah. No, Matt, thank you for hosting this. It was our pleasure. And thank you again to everyone for attending. Our contact details on the screen. Please feel free to reach out, and hope to do this again soon.
Perfect. Thanks, guys.
Thank you, Matt.
Thank you all.
Thank you all for joining. Thank you.
Thanks a lot.